So thank you very much, everyone, for joining us and for putting up with our banter for a couple of minutes. We were simply just waiting for more of you to join us. But being cognizant of all of our times, I want to welcome all of you to this session where over the next hour, we are going to be discussing how ultra HNIs and family offices are approaching the private markets in India and outside. The framework for the session today was very simply that when Trica Capital began looking at facilitating investments for family offices and ultra HNIs in startups, we found that there was a lack of data and a lack of information for people to really understand what was happening in this side of the market. And where we found a good amount of data, we found that it was not qualified enough. And it was with that framework that we actually partnered with EY to put together the Private Market Monitor, which is first of its kind survey of over 100 family offices and ultra HNIs to understand the approach that they have taken in the last 5 years to private market investing, as well as what they see going forward as some of those trends. So just to put in some context, the highlights of some of the findings were that family offices were allocating as much as 18% to private markets, right? Which is a considerably high number when you look at, a 36% allocation to public equities. The other trend that we saw in line with global trends as well was a preponderance to invest directly into startups and balance that out to a lesser extent with, fund-based investments. So keeping that framework in mind, let us actually dive in. Let me introduce both Chandy and Nimesh, and then get into maybe a 15 to 20 minute guided conversation. And then we will open it up for Q&A because we would like to hear from you what your own impressions have been investing in startups or funds in the private market. And if you all, of course, have questions, both Nimesh and Chandy are more than happy to answer those. So you can use either the Q&A window or the chat window that you see at the bottom of your screen to put in those questions. But let me quickly do a one-line introduction to both Nimesh and Chandy. So Chandy heads up the tax practice and the private client group at EY. And he is, for all practical purposes, a tax expert on how family offices are looking to set up their investment offices as well as manage their wealth. Nimesh comes with over 20 years experience in banking as well as the capital markets. And he's a co-founder and CEO of Trica Capital, which is essentially a platform that helps you invest into growth stage companies in India, as well as some select opportunities outside. So thank you, Chandy and Nimesh, for joining us today. And let me begin with you, Chandy. Give us an overview of what you have seen evolve actually in the private market space and with the family offices in particular, right? In your practice, in your observations, how has the family office as a structure or a construct evolved in the last 5 years? And what have you seen as some of the key trends as far as their setting up of investment offices to look at opportunities more closely?
Right. No, thank you, Saina, and good afternoon to everyone. So we'll try to answer this, and all of you all are experts and have done it in a particular way. The starting point is, and Saina has asked two questions: what are we seeing in the market, and what are the structures? So I'll answer what we are seeing in the market. That's an easier answer, and all of us know it. Is that opportunities are plentiful, and there are all ideas are getting wings because of private capital that is coming into the market. We are also seeing and just practical situations. A lot of the venture funds, the old age venture funds that used to put the $500 to $2 million, the overseas venture funds, they have really pulled back and gone to 5 million checks. It's because of the large amount of private capital and Indian, like Trica Capital, Trifecta, all of you all who are coming in and doing a lot of early stage and so on and so forth. So This is the private capital, the family offices, the wealthy individuals have become a large part of the investment cycle. They are taking a large chunk of the risk, and they are putting a chunk of money. Now, that being said, what are structures? Historically, who are the people investing? Very high net worth individuals or corporates that had surplus cash on their balance sheets. Now, as this has evolved, all of them, we'll come back to the tax and regulatory reasons, etc. But all of them are looking at, or rather, all of them, if I may use the word, have tasted success here, and are therefore saying we need to do this in a more organized manner. We can't do it with, balance sheet, what cash is available. Let's see if we can put it in this. Let's go out with a plan that I want to invest X crores, tens of crores, etc., and create an office to really do this. Now, what will the office do? I want it segregated from my, if it's a balance sheet investment, I want it segregated from my regular business, and we'll see, and we have seen a lot of those getting created. And then I want to be able to hire people who will source deals, who will network in the market, who will support the companies after we invest, because that's a key part. A lot of these family offices are playing, that they support companies in their growth. So therefore, creating a new structure, a separate organization that can house the experts and house differentiated skills has come into play. A lot of them are also doing AIF structures where they're saying we've created this network, we've created this intelligence. Can we pool capital of those who are not going out and setting up their own family offices? Can we take the 10 crores, 20 crores instead of having 50 crores to invest? So an AIF structure, given its transparency from a tax perspective, is giving the right answer. It's regulated. Therefore, the NBFC pressures go away. Therefore, balance sheet, managing this on the balance sheet constantly goes away. So in summary, if I may, Saina, we are seeing private capital sort of coming into the market in a big way, and we think it's here to stay. They are helping startups, in kind of thinking of their future. How do they want to do it? Unit economics. So they're getting very actively involved, the early stage money, and more specific structures, and not doing it, on the side. This has become the main business for a main activity where you may do it yourself, or you may hire teams of people to do it. So that's really what we're seeing, Sai.
Oh, that's wonderful input, Chandy. Just taking that forward with you, Nimesh. Today at trica, we work with over 200 odd family offices, ultra HNIs, who for practical purposes might actually overlap in what is typically seen as a family office group, or want to formalize their investments as such. Do you want to share some instances from some of the better or best practices that you've observed in terms of organizing the investment office, particularly with the idea of wanting to double down on private market investments versus certain other asset classes where information and know-how on how to approach that is more easily available, even in terms of talent of the people that you might want to bring to your family office?
Thanks, Aina, and good afternoon, everybody. So let's just step back and see how this ecosystem has evolved, right? I think even if we just go back 5 years, right, I think there was no construct of family office in India, right? I think it all started with creation of trust and, getting money to be pooled in there of the entire family and started investing. And what we see is typically there are three types of family offices and ultra HNI group, right? One is a traditional industrialist or businessman who has sold his business and is sitting on cash and wants to invest. And that is one part. Second is the younger generation, which is well-traveled, which is educated in the US or the UK. They come with new age ideas and they want to bring in the digital world into their businesses. They start investing in adjacencies and businesses which make sense for them. And from there, they get on into investing into the startup ecosystem. And third is the ultra HNI professional network, I would say, which is the ones who have ESOPs and over the years have created huge amount of wealth, right? So these are three categories of investors. The structures, as Chandy was mentioning, it has moved from starting with a trust structure or a simple structure and then formalizing it with an AIF. In addition to what Chandy mentioned, I think AIF also has an advantage that you can invest in IPOs and sell it on listing. So there is one thing that had caught flavor in the recent listings that we saw. So a lot of them are going towards the AIF structure. From being just a family run investment office, today we are seeing a lot of family offices structured with professionals running it, right? And with the kind of funds we have in India, we would be having close to 500 funds. There is a lot of talent available. So the family office would go and hire a team of professionals that run the entire investment process. It's actually run like a fund. So the structure is AIF, which is tax efficient, which allows a lot of flexibility. And behind that, the entire backbone is also run like any other fund, right? So I think you're seeing that evolution happening. We are not yet that in terms of the large quantum of family offices running in this manner. There are few which are outliers, which have become pretty large, and everybody knows the names out there, who have their own sourcing teams, who have their own evaluation teams. They actually are run like a fund. But there is a large middle bulge bracket, which has 1 or 2 member team. They have the ability to evaluate a deal. They have the ability to work on it, take it to the IC and take professional calls. But yes, where we come in is we come in for the sourcing of deals for them, and they work very closely with us. And of course, there is a long tail of family office and ultra HNIs which take their own call. I think that is where the evolution will happen. You will see more and more people setting up professional structures where it's not just a family member taking a call. It is a proper IC-based decision making. In fact, some of them have got third-party investment experts to come on the advisory panel to advise them. So I think that evolution is happening. I would give it around 2 to 3 years where you'll see the entire family office setup being a very professionally run fund setup, and which will bring in transparency. It is registered with SEBI. It complies with all the laws that we have, including taxation and all, which Andy will touch upon. But I think it's the most efficient way in which people are doing it and running it in a very professional manner.
All right, great. Taking this forward, Nimesh, because you mentioned, the IPOs and the imagination, right? I think people really got enthused with the exits that happened in the last year, right? For people who would have stayed invested in the private markets for a long term, actually found exits via the IPOs. Given that we are still, if anything, at the beginning of a 10-15 year journey as far as the evolution of private markets in India are concerned, give us a sense of what we saw from the survey as well. What are some of the stages at which individuals and family offices like to invest in? What is, where would they like to be? How do they try to or tend to distribute their portfolio across stages? And what are some of your own impressions on what could make a good mix?
So it's the way it's evolving and the way you are seeing it develop. It's like a dumbbell, right? So the dumbbell is at the top end. People want to invest in pre-IPO because it's lower risk. If you're a first-time investor who's only invested in public markets, wants to come to private markets, you come with a dumbbell and you invest in pre-IPOs because it's the lowest risk. The returns are not that high that you would see in any other startup investing, but your risks are pretty low, right? So you start with that. So that is one approach where a lot of family offices have taken. The other approach is to go early, right? Because when you go early, you can actually spray and pray, right? Because you will have a portfolio of around 30-40 companies, right? And of course, there is a due diligence, there is a level of checking done, but of course, we all know that, beyond Series A, 60% of companies don't survive, right? So I think, so they will put in checks of an equal amount in 30-40 companies, of which 3-4 will become very large. And that's how they get into the ecosystem and learn the ecosystem, or they come in at the end. So that's where the bulk of the new family office money will be flowing. But I think once the maturity comes, once the understanding comes, they go in the middle, right? So I think the growth stage is where they really prefer to get in because your risks are lower. The returns still remain very high because you're investing in companies which are $100 to $300 million valuation, right? And that's where it makes a lot of sense for them. So the way, if you look at it, the first time investors will go into a VC fund, right? They'll go as LPs in funds. They will start working on co-allocation on certain deals because they want to invest directly. And as you said on a survey itself, 18% of capital is allotted to private markets, of which 47% is going in direct captive investments, right? So here also the way it pans out is that, they get a very limited choice when they go as LPs on funds, right? If I were to draw an analogy, it's like, you go to a restaurant and you order a set menu, right? The set menu or the thali will have 20, 30 dishes. And that's what you get when you invest in a fund, right? Now, if you want to have a a la carte option, you want to look at the entire 300 items on the menu, that is when the maturity comes in and they come to people like us, right? As Saina was mentioning, we are around 800 investors on the platform today who want to invest directly on the cap table, right? Because they already have done LP investments, they've already been working with funds, but then comes a stage where you want to invest directly, you want to get involved with the company in some manner, you want to work with the founders, help them grow. There are different objectives, but primary objective for everybody remains making money. But in addition to that, it also, you want to contribute in some manner, and that's why they would want to come in directly on the cap table. And we are seeing that more and more happening. Of course, with the plethora of funds that we are seeing that have come out and the amount of money that has been raised has been at a different level. I don't know how people are going to deploy that money because the quality investment opportunities will remain the same. It's a small circle, but that time will tell. But I think you start investing through an LP model or going the dumbbell model, right? But ultimately, eventually, you come and settle down in the growth stage.
What have been your own impressions on this, Chandy, from your own private client practice? What have you all observed? It is a fact that, for first time or newer investors, LP investments into funds make more sense. What have been your own sort of guidance that you've picked up from your investor group?
Yeah. So it's an interesting question, Saina, and you'll not have complete empirical information on this. But this is a market, or this is a area of opportunity where private wealth has largely sort of not been able to get in. They were forced to get into funds because the whole concept of family office platforms, all of that were not there. And the number of funds that were pooling in India were also low, right? Most of the money came from overseas.
Right.
So it was really, and if you see the evolution, I'm talking of 10 years back, it was, you knew people who had money, you went with an opportunity, they saw two opportunities instead of 20 and put money in one of the two. But as time has passed and they have seen this whole hockey stick growth, they have sort of, and Indian pooling vehicles have started becoming active. They have largely started with, till they get the taste of it, investing as LPs. Investing as LPs has not gone away because the strength of the GPs is there, right? They are able to suss out. There are multiple funds with multiple strategies and expertise. So even if they are setting up their family office, they would allocate a small portion still, or they would allocate a portion still for investment through the funds, the polling vehicles which GPs manage. And to use Nimesh's word, it comes in a fixed menu kind of thing. But they have also got excited. The next generation of the high net worth individuals have really got excited by this whole thing. Family offices, single LP funds, all of that has started growing, has come into play, and a lot of them are taking risks at early stage. Now, there are a lot of people who say we want to be the first investor. If there's any institutional investor, we will not come in. So it has gone to that extreme, right? High net worth individuals saying we want to be first. If there's institutions, we are not coming because they want the pop at that level as well, from zero to the next level. So it's all over, but it's all over the place in that sense. There isn't one strategy, but as they evolve, they are the allocation between the types of assets and the risk in each of those assets is becoming clearer to them. So some have a higher profile. Some are, putting only 5% of their wealth. That may still be a large amount. So they're saying, let's take all the risks that we can, so on and so forth. That's how we are seeing it. But there is, every other person we meet has has invested in one opportunity or the other, at least, even though it's not done in a rigorous manner. But you have friends and family rounds, as you call it. You're actually friends and family are putting money.
Right. You
I just
mentioned
add
this.
to that, in fact, just one
Yeah.
data point from our report is that 83% of the family offices that we surveyed said that they have double-digit allocation to private markets, right?
Yeah.
And around 40% of them had double the allocation in the last 5 years, right? And yeah, private markets includes both coming in as LPs and direct investment. So it has been steadily on the rise. And what Chandy was saying is that everybody wants to be part of that game now.
Yeah. All right. Chandy, I'll continue with you for another couple of minutes. You mentioned risks, right? And this is something I think in the EY Global Family Office survey in 2021 that you all looked at, and that, there were certain risks or, overhangs that family offices were concerned about. I think it would be nice to understand from a global perspective what some of those overhangs tend to be, and a framing to look at the risks.
Yeah, so I think family offices is a global concept now. Everywhere, this is rife. And as EY, we had done a family office study in 21. I think the most significant concern among the family offices is the regulatory structure. What kind of structure do we need to put in place? The exchange of information and the transparency that is required, because a lot of these private pools of capital, as the name suggests, they're very private people. They wouldn't want all their data and all of that going around. Not that there's anything wrong with it, but it's just the transparency and the regulatory overhang that comes with it is something that is not palatable to a lot of people. Then you have family offices as they grow in bulk and subject in India, subject to exchange control, but overseas jurisdictions not really. They are going cross border. So US is coming to India, Germany is coming to India, Germany is going to Africa, so on and so forth. So as they do that, the other concern that a lot of them are having is that we need to now rely on a lot of outside support. And what is the strength of the outside support? What is the quality of the outside support? So that's another area of concern. Now, this concern is, for once, we always complain that can the government do more? This is not something the government can do. It is one, all of us have to gain comfort, confidence, networks, etc. So the use of external professionals, the setting in of the networks, so on and so forth, is the other concern they have. Uh, and a lot of these family offices are also realizing that it may be prudent to have a smaller, tighter team who take the final decisions, who are the final, who make the final decision. But let's outsource more and more. Let's get professionals involved in their areas. We don't need to get everything onto our books. So that's the other aspect that's prevalent, and the risk that brings about, right? Exchange of information,
Correct.
propriety, confidentiality, expertise, so on and so forth. So our so the EY report has really shown that this is a growing market, but this is private pools of capital. They are not used to public focus and public gaze. So they want to be more careful, and they're worried about blowbacks. In that you go in early to a promoter and something comes up there. Am I left holding that, that baby, so on and so forth. So those things are also, cross their minds.
Got it. Interesting. I think, a perfect segue to a question that Purnima Nayak has asked us. What are the top 3 must-haves for a new family office to keep in mind? I'm assuming, Purnima, this is from the perspective of investing in private companies. But both Nimesh and Chandy, if you all want to expand on this a little bit, top 3 tabs for a new family office to keep in mind.
I'll go there, Chandy. So I think first thing I think is the structure, which Chandy has said enough about it. I think structure is the first thing you should get in place. And I think AIF is something which is being pretty common now, very transparent, and it works very well. I think just before even you start setting up the structure, getting your team in place, I think setting your investment thesis and strategy is very important, right? because believe you me, I think any startup that comes to you when you're starting out, you like and love each and every one that comes, right? You want to write a check for everybody. So somewhere you have to draw a line, right? And sooner you do it, better it is. So I think getting your investment thesis right in terms of which sectors you want to invest in, what will be your ticket size, what will be the role you want to play, how much you want to invest, commit over a period of time, so that you can decide on your ticket size for each investment, which stage of the company you want to invest. So I think these are some of the very important questions that you need to answer. And it always makes sense to bring in a lot of objectivity in your decision making, right? Because I think it's good to have a checklist in of sorts in place. It helps you to decide, these are the kind of things which make sense. And I think as you evolve, I think the checklist also evolves and objectivity also keeps on increasing, because more subjective it is, I think more tendency to make mistakes will come in. So I think the best way forward would be to make it very objective. And the third one I would add is networks, right? So I think the easiest strategy that anybody has followed till now is being LPs on funds, because that gives you co-allocation rights, co-investment rights. And now like platform like ourselves are there, which gives you access to deals. So I think networking is one very important factor there as well, because it's all about deal access. And the best of deals, get consumed very fast. So I think these are the 3 points I would want to highlight. Chandy, you want to add anything more to this?
No, I would agree with everything you've said, Nimesh, that get the thesis right, get the allocation. If you're working with a large family of, get the allocation. What is the capital that is being allocated? Because that helps you select reserve for follow-on investment, so on and so forth. And the objectivity, and therefore family member or investment professional to select basis thesis. It's difficult to say no, right? In the Indian context, all of us find it difficult to say no. But saying no is a big part. So what is the structure that you put in place? And obviously get your networks. When you're starting off as a family office, you may be well served by tying up with others, sharing deals, sharing the upside, that giving space on something you find, so that you get space on something that others find. So that network effect is really important.
Right. As an extension of this, what can be done, or what are some of the yardsticks to look at performance of a family office? You want to reflect on this, Chandy, and then we can go to Nimesh.
Sure. I think see, a family office is to funnel the wealth of a family into multiple opportunities. So the first thing is it's like a green fund, right? An evergreen fund. You don't need to repay the LP if you get the allocation right, if the LP has allocated right. Therefore, you are long-term capital. And with long-term capital comes a lot of, there will be the noise and the froth and the faults, but you need to be sort of insulated from that. So your investment calls. So therefore, in a family office, you have the ability to take much longer term calls. Now, as you do that, you have to balance that with by taking these very long-term calls. Are you missing out on the short-term opportunity? Therefore, one has to be pragmatic in how this happens. So for a family office, the measures of success really are: what does the family want if an investment professional is running it? What is the objective of of the family? That create long-term capital, create institutions for me, create where I have a 20% stake for the long run, or is it a 5-10 year IRR based, fund based? You hire GP like people in your family office, and you expect an IRR. Both options are available. It's really what the LP of the family office, that is the family, really wants. What is the kind of structure? And we have seen both happening.
All right, this is very interesting, actually. Chandy, you've in part, or actually in full, perhaps answered Harshavardhan's question that had come in, which is what are the things other than IRR that LPs are looking at when investing in private markets? Nimesh, you want to add on? I think Nimesh mentioned, Chandy mentioned institution building, or a sort of more overarching framework for how you're approaching the private markets, apart from just the returns, financial returns.
I think in addition to what Chandy mentioned, I think one other aspect which is very important for any family office is your thesis, right? Because you don't want to be a generalist who's investing across the board, right? Because then, of course, law of averages comes in, and we have seen that enough number of times in public markets, how your returns are impacted. So here you can really have a concentrated strategy, unlike a lot of generalist funds which have a very generic strategy. You can select the sectors you want to be in. I think it's completely your decision on how you want to run the fund, including long-term, short-term, including your periodicity, including allocation between that entire fund allocation that you want to do across stages, right? So I think that gives a lot of flexibility when you are running your own, AIF structure or own family office. In addition to that, I think I would just want to add that apart from returns, it's about the involvement that you want to do. So in fact, there are a couple of funds which run in that manner, right? Where they will raise a few $1 million and will have very concentrated bets because they work with the founders to build the companies, right? So I think it's up to the family of a thesis on where they want to invest, whether they want to go very wide and invest in 100 companies through being an LP and having mirroring that kind of structure. I think a lot of early stage family offices will want to do that because that gives you a good chance of making good money. But a lot of growth stage family offices like to do concentrated bets, right? They like to take a decent percentage into the companies so that they can play an active role, not in running the operations, but in at least guiding them because they have that experience of running large companies, right? So I think that really helps. And purely as financial investor, I think there are two examples that come to my mind. One is Nykaa, which had participation from a lot of family offices, and everybody knows, the kind of returns they have made. The second one that comes to my mind is Dunzo, right? I think Dunzo was also another company where a lot of family offices invested very early on, right? So I think Nykaa was in different stages. Dunzo family office came in at a very early stage, and of course, the returns are for everybody to see. So I think backing the right founders, backing the right promoters, and family office have a natural eye to recognize that because since they've been doing this for years, it makes a lot of sense to go beyond just the IRR numbers that you look at.
Right. If I may, I mean, I recollect from one of the interviews that we did for the report, right, with a large Bombay-based family office where actually their philosophy was how do we remain, this is a family that has been sort of very active in the real estate space, in the philanthropy space in Bombay. And they, their sort of large construct was simply how do we remain relevant to the next set of entrepreneurs in our country? How do we stay relevant in the technology space where perhaps they, don't have a very strong legacy in that sense? Correct? That could be some of the framework that could be used. Do we also see, Nimesh and Chandy, families that have their core business in a certain sector or in a certain area? What is the thinking? Is it let us diversify from that and look at opportunities in completely different spaces so that our overall profile expands? Or is it to double down on that space because that is a sector or an area that they are well familiar with, can better assess opportunities, and then perhaps, though perhaps not ideal to convolute both, but perhaps also look at larger strategic tiebacks to the original family business?
So,
Yeah.
can you want to go?
Sure, Nimesh. Continue.
Okay. So I think we have seen a mix of both, right? So there are family offices, say, which have a traditional textile business, right? And they like to invest in primarily businesses on B2C side, largely on the fashion side. There are family offices which have been in B2C businesses, right? And they primarily invest only in consumer-led businesses. So I think that is something that we have seen, but there are other families who actually diversify their portfolio and want to contribute to the larger good of the ecosystem, and they invest across the board. So it all comes back to what your strengths are, what your thesis is. Are you running a professional team? Because a professional team will be able to evaluate things across the board, right? But if suppose it's a family who's running the entire long and short of the fund or the structure, they will prefer to go into what their expertise lies in. So I think it all boils down to that, right? Chandy, over to you.
Yeah. No, I think to add to that, families are looking at their risk profile, right? This gives you a risk diversification mitigation strategy. Now, let's say there's a business that has been on for 2-3 generations, and we constantly say India, 2-3 generations, the family businesses struggle. And one reason for that, it's not because of lack of effort. It's because the thesis on which the business was formed and made has completely changed, right? In the tech world, the thesis has gone away. So by making the next generation slog at the old business, may not give the results that you want. If anything, it will pour your family wealth down that same business. So therefore, people are looking at, can I diversify and de-risk from my, if I were to take Nimish's example, I've been in textiles. I'm doing woolens, or I'm doing cotton, or I'm doing denim. But if the style changes, what is the risk? So therefore, can I de-risk and get the next generation who may be more comfortable having studied at different places, more comfortable in the tech, in the different new age businesses, and those entrepreneurs then getting newer ideas, right, by going into these new age business. So one is the risk profiling and the risk mitigation strategy that people are looking at. The second is, a lot of families, if they're investing from the balance sheet, not if they have a separate office, they are thinking of, I want to stay relevant. I want to know what's happening. I'm on with blinkers and I'm just doing my, again, the example textile. I'm sitting in the loom. I don't know what's happening. There's so much happening. There's so many opportunities. I have so many networks. My father and grandfather knew everybody. I know everybody, but I'm not using anyone. So therefore, start investing to get to know the new world. That's point number 2. And when you make investments, I think if one goes in with the approach, whether family office or otherwise, that I will invest like to only make my business bigger. So if I'm textile, I'll invest in technology in concentric circles around that. What happens, what I've seen is, the founders and other investors may not fully like that, because they feel that this is the strategy is to acquire by, the family will come and acquire because they want it, and therefore the upside may be limited. So therefore, sometimes if you point yourself only to taking a large stake and then merging it with your business, the investee companies sometimes have concerns that, is my road only 100 meters? I want to run, a kilometer, but you'll take me over when it's 100 meters. So things like that. And also, if you come from the old world and you invest in the way the new world is running the old business, the startup guys are in their 20s, right? You feel quite different when you go there. So they also worry that old ideas will get imposed. So therefore, one has to look at all of this and say and feel that if I form a strategy that is self-limiting, is that useful for me and my wealth creation objective? Because at the end of the day, this is a wealth creation objective. So that's how families, there are different ways in which, and you have to come to a thesis. As Nimesh is saying, it's important to come to a thesis, otherwise you're spraying, right? If you're doing real estate on one side and SaaS on the other side, which GP will have the expertise or professional have the expertise to manage all of this? So, but even in forming the thesis, do you want it concentric to your business, different from your business? Do you want the spread Southeast Asia investments, US investments, so on and so forth?
All right. Again, a good segue with the mention of Southeast Asia and the US. Question from Viral Puta. Are Indian family offices investing in overseas private markets? If so, what are the available structures to enable such investments?
So this is India has exchange control. So any capital investment outside, unless it's specifically permitted, comes with the need for approval. One can do ODI, but you can do ODI only if you are, and whether ODI is financial services. So there are loops within loops here, but ODI is one structure. Otherwise, the AIF allows you to make 25% of committed capital. AIF is the other route. And there is a lot of asks that SEBI has received from a lot of you and a lot of investors that please expand this 25% of my capital base, because it restricts me. And at the end of the day, I'm going to get all the money back. So if anything, it's only useful for the country. So a lot of pitches have been made. So AIFs, the ODI option, these are the two options that people have really used. There are more complex structures of NBFC investing in financial services, but all of those are one has to really structure that carefully. It's probably a conversation for a whiteboard, a discussion, and specifics.
I'll just add to what Chandy mentioned. In addition to ODI and the AIF structure, I think a lot of investors are using LRS as well. And we are seeing that happen across multiple family members. Your LRS limit of 250K, it is still allowed, though there are some murmurs and there are some draft guidelines to not allow it in the portfolio investment scheme, but people are still doing that. So up to 250K is through LRS, which is also being done.
Yeah. And LRS, as Nimesh said, is meant for individuals. So family office structure, you may not be able to.
May not be allowed, but they invest in multiple family member names.
Yeah.
And good to see you, Viral. I hope you're doing well.
All right. I think we have about 10 odd minutes to go. So I'm going to request other folks to also put in your questions. In fact, if you want to participate and, actually ask a question, you can raise your hand. So if you look at the panel at the bottom, you will see a raise hand icon. And if you press that, you can actually participate more actively into the conversation. But till we wait for another question to come in, one from me. As far as, public market performance is concerned, and Chandy, you spoke of this right at the beginning, right? What brought in the large sort of pop that we saw in India, right? The fastest creation and the largest in terms of volume creation of unicorns last year. In fact, if I caught a headline this morning correct, we've already had 12 odd unicorns created just in the last 3 months of this calendar year. And few years back, reports said 150 unicorns, right, by 2025. So clearly those reports and those predictions will have to be rewritten. But let's look at it from a more holistic point of view. Money flows globally. What can we expect in India? Will we see a tempering of expectations, and how do you take that in your stride?
Right. So as soon as a tax professional tries to talk economics, you must take it with a pinch of salt. But I can tell you, generally all of us are aware, India is loaded with talent and opportunity, and all these startups. What is their thesis? Irrespective of which sector they are in, they are looking at a problem statement. They are looking at improving efficiency. So, what's the problem in the supply chain, in the manufacturing, the distribution, so on and so forth? And can we introduce efficiency in that through technology? That's the whole technology SaaS space. Then obviously there is, import substitution, manufacturing, new technology, etc. So if you take all of this together, India is poised at the right place, right? We need a lot of upliftment in terms of technology, the spread to the markets, so on and so forth. So India will continue to churn, and the whole nature of Indians, right? We are all, or rather, the large majority of people are entrepreneurial, have ideas, are willing to work hard, so on and so forth. So India will continue to offer the opportunities, and therefore, and there is enough and more money that is flowing. That money is looking at the right opportunity to invest in. And there's a lot of money following the money. In that, if there is success, the people with slightly lower risk profile will also come into the picture. So there are high risk takers who have made, all these unicorns that you referenced, and newer terms, right? Decacorns. Somebody was telling us, we are only so many decacorns. And then someone else was telling me, I'm a Sunicorn. I said, okay, Sunicorn is soon to be unicorn. So, you have all of these terms being developed, but you have the lower risk appetite money that is also now, and you see a lot of European money coming into India.
All right.
So I think the money flow will continue to be strong, unless very large geopolitical matters. But India continues to be the recipient of large pools of capital because of what's happening globally. China and the world and India providing this opportunity and an ease and it's a generally, if you compare with China, it's an easier regime to work with the Indian regulations. It's there, but it's much easier. We may not be completely open if now people are talking of, can you have full convertibility, you take out as much money as you want. That's dangerous in a developing country, right? You can't just open up the tap. So I would say if, this at the end of this long ramble, I think the next 5 years at least the next 5 years will continue to be really good unless things go dramatically wrong, is what I see on the ground. I sense on the ground.
Okay. All right. Ishan would like to participate. 1 second. Yeah, there. I think you can unmute yourself. If you feel comfortable putting your video on, please go ahead.
Yeah, can I ask my question? And am I audible?
Yes, please go ahead.
Okay, so a really interesting session. I'm actually 23 years old and I'm applying for like places in venture capital and as such. So this space is very interesting to me in general because I find the development in capital markets very interesting. My question is that what do you feel about, to both of you, what do you feel about the model of SPACs as such? That is it possible to get that in India where instead of having to go through the typical IPO process, we get family offices involved in SPAC listings, where if as you said, the primary function is to just funnel the wealth from place A to place B, isn't SPAC a better option where we can get a lot of these investment bankers off the table, actually have retail investors enjoy the wealth from a good company and have family offices benefit from a SPAC as well? So there's not that much of a long-term capital as such.
On SPAC, I think I've written a detailed note, which you can see on the trica website, which will explain to the entire concept of SPACs. I think one very important thing to look into SPAC is the kind of companies that were listed through SPAC in the US and the kind of returns they've given. Right? We've done a detailed study on that, and I really don't find it very attractive as a model to list your company. But happy to share my views offline on this in detail. If you can go through the note and you can reach out to me, happy to give you my viewpoints on this.
All right, Chandy, any thoughts on SPAC?
I think it's a very nuanced conversation, and SPAC is not new, right? It's been there from the 80s.
Yes.
Today, as a regulation stand, you have to have a cap table outside. And the SPAC doesn't take away any investment bankers. A SPAC is an already listed entity with pools of capital lying in escrow. So it's not, anyway, it's a very, very nuanced one, as Nimesh said. So I suppose that note, I think Ishan, you must look.
Yeah, we'll do that. I'll post it, or Aman from the team can post it in the chat window for all of you to look at. And I think a good note to end on, Harsha asks for some good books and reading recommendations. Sorry to put both of you on the spot, but something that comes to mind, or perhaps names of just, investors or articles or long form content that Harsha can access or start reading to understand investments in private markets better.
There are two parts. One is go through a lot of blogs. In fact, our trica blog is there, but I think apart from that, there are a lot of fund blogs which throw a lot of light on, the companies and how to look at them and how to invest. And for data, I think EY has the best reports. I think they regularly release their private equity and VC report. I think that's a very important data point, which we ourselves use it a lot. So I think these are the two sources I'll recommend. Books at the end of the day would be a single person's view. It all depends on the person's thesis, the person's investment style. So I necessarily would not recommend a single book, but I would recommend to go through blogs of large VC funds in the US. I think there's a lot of material out there, and our trica capital calls as well, right? And EY reports for sure.
Yeah. Thank you, Nimesh, for referring to EY. But yes, there are a lot of.
I use it a lot, Chandy. I use the EY reports a lot. So
there are a lot of books
data
out there.
Yeah.
And there are people, the oft spoken of names, right? Charlie Munger, Warren Buffett, Peter Lynch, while they're doing listed securities, their thesis is something you must understand. And if somebody is getting into investing as a full-time profession, I would, only quote what other GPs have told me, that you have to read in concentric circles. You need to have as much, how will you, you need to have a frame of reference to make a decision to invest. How do you get the frame of reference? You need to read, you need to meet, you need to greet. So reading all across, right? If you're an accountant, read about technology. If you're a technologist, read about, cyber crimes. That kind of thing. You need to have a frame of reference. So read as much as you can. These blogs of the VCs, Trica, everyone else, very, very thought-provoking. They give a lot of juice out there. So read as much as you can. It may not be a particular person's. Read as much as you can.
All right. Just to wind up, closing thoughts from you, Chandy, and then Nimesh on the road forward. What are some of the things that folks who've been attending today can keep in mind as they approach private markets, especially from a short-term perspective?
Yeah, I think if I were to go first, the market is there, but have an objective basis of selection. That's very important. If you're first time in the market, don't try to be a contrarian the first time in the market. Once you're there, you can invest, but try and form the network that Nimesh spoke about, as in get first we'll just stand on our feet, so on and so forth, find out. So I would say that the market is there. It's how it's how you deploy your capital. Try to lose as little as you can.
All right, Nimesh.
I would just add two things. I think we're just at the tip of the iceberg. I think 120 unicorns is just the beginning. I think the next decade will belong to Indian private market investment. And that is also based on data. Like if I just go to see, I think all the unicorns that we see today have 150 million customers. And India is a country of 1.4 billion people, right? If I look at just the China market, the decacorns that are sitting there have 87% penetration in the population. So it's just a matter of time that you will find entrepreneurs who will crack this model of Bharat, so to speak, and we'll see more decacorns coming out of India, more unicorns coming out of India. In fact, I'll just add one more data point is that we did a study in the report on how the private markets have performed vis-a-vis the public markets. So we took the Nifty and compared it with top 50 companies in private markets. The last 7 years, the CAGR return of public market was 11% and the CAGR return of private market was 35%, right? So I think this is just the beginning. As Chandy mentioned, be very careful in your thesis, be very careful in where you write your checks, because it's just a couple of checks that can go wrong and it can demotivate you, it can have any kind of impact, it can pull you back. So the right approach is to go with knowledgeable people, build your networks, go with the right sources, build your portfolio over time, don't be in a rush. It's a long story and we all will have to make money in this. Thank you.
Okay. Thank you very much. Thank you, Chandy. Thank you, Nimesh. And thank you everyone for joining us this afternoon. I've put in some of the links to both the report that EY and Trica worked on together, which is the survey of family offices and how they are investing. Also a link to Trica resources where you can find a ton of information and long-form content on private markets, sectoral studies, as well as other material. So on that note, thank you very much and do stay in touch. I had also put my coordinates on the chat earlier. Would love to hear from some of you and be connected. Thank you.
Thank you.
Thank you.